Hey, this is Hector. Thank you for giving me about 5 minutes of your time today. We're going to touch on just a couple of things, and hopefully you'll find them useful. First thing is we want to wish you a happy Easter. We pray a blessing over you and your family, and we know that this Easter is going to be way different than all the other Easters, but we pray that you're safe. We pray that you continue to be safe and you continue to make sure that we're socially distancing. So the first thing I kind of want to show you guys is, what is on everybody's mind, and that's the stock market. And so we want to make sure that we're taking a long-term view of this thing, and that we see that it's been on a good march. And before this pandemic hit, we had a good thriving economy. We think it's going to be back. We own good companies in the portfolio. They have great balance sheets. They make good stuff. And so there's not any reason to panic and sell them right now. So we want to keep a long-term view. I know that you already have. If you've not sold into this thing, congratulations. You're going to be real happy that you didn't. Next thing I kind of want to touch on is a thing called required minimum distributions. They've been waived for 2020, so that's a good thing. So if you thought you owed some required minimum distributions, you don't. If you've already taken them, you might be able to get that re-put back in your account. And then if you turn 70.5 in 2020, and you're thinking this will be the first year you've got to take a required minimum distribution, more good news. Now they moved that back to age 72. If you needed to take one last year, sorry, but if you start this year, it's a good thing. On taxes, April 15th is now July 15th, so you've got until then to file your taxes and to pay your taxes. And you also have until then to fund your IRA. So if you haven't done that and you're eligible, it would be a good time to do it. We had some really good questions come in, but one of the ones from a younger person, one of our younger clients, and so for some of us, this might be something you share with your kids or your grandkids, is if I'm putting money on a pretty consistent basis, or if you're in your 50s or even in your 60s and still working, if I'm putting money in my 401k in a market like this, should I continue to do it? This is something I've been using for a while. I broke into the industry doing 401ks for state employees and then 403bs for teachers. So we had this question come up a lot. So here's a person that's doing a $100 investment. It could be 1,000 or 5,000 or 10,000. But they're putting in $100 and it's going to be a systematic deposit. It's coming out of their paycheck. And their share price is $10. We don't know if that's a stock or if that's an ETF or if that's a mutual fund. We don't know what it is. And we know that whatever it is that he's buying, that share price is $10. And that means that that month he got to buy 10 of those shares. So now he's invested and he owns 10 of these things. Next month, $100 comes in. This time the share price has gone to $5. But he's able to buy 20 of them, so that's a good thing. Third month, $100 comes in. Market has had a pretty good recovery. The share price is back to $10, so that's a good thing, and we're able to buy 10 shares of that. So that completes the first quarter. He's going to get, or she's going to get, the first statement for this investment, and let's see what it looks like. Of course, she put $300 in, so she knows that. She also knows that the share price started at $10, and now it ended at $10, and so that's what the statement is going to show, and it's going to show that we bought 40 shares of this investment. It's also going to show that when you take the 40 shares and you multiply them by the share price, that the value is $400. The account value is $400, even though we put in $300, but the share price started at 10 and it ended at 10. So the question comes up, where did I make the money? Well, you made the money right here. When the share price went down to $5, your $100 bought 20 shares instead of 10. And so that we call that buying low. And that's exactly what this is. So you want to make sure that when these things go down, that you realize that that's when you're making money. To do that, you had to sit through this. You had to start at a share price of 10 and drop all the way to $5 and then wait for it to come back. But if you do that, you can see that you make money even when your ending and starting prices were the same. So buying low and selling high, that's a good thing. But if this client, and this is the counterintuitive, people do is I bought this at $10 and now it's only worth $5. I need to sell it. Well, if you do, you would have bought high to sell low. That's a very quick way of making sure you run out of money. So if you bought high, don't sell low. Don't sell. Just hold on. It will come back. Again, my name is Hector, and our website is swandfw.net or idon'twannabepoor.com. That's what my clients ask me. It's my phone number and my email address. If I can help you in any way, please feel free to call me or send me an email or check us out on the website, idon'twantobepoor.com. Thank you, and God bless.